Good afternoon, everyone. This is Ryan Mallory for SharePlanner.com. Today is August 14th, 2015. Doing another Google Hangout with you guys. Hope everything is treating you well today. And if you guys are like me, I am ready, so ready for the weekend. My gosh, this has been a crazy week in the market. Seen no better than the price action that we got out of it on Friday or on Wednesday, where we were down like 32 points at one point, and the bulls, the dip buyers, they come back in and rally this market some 34 points off the lows. China's been a huge issue. That was sort of a thing that no one saw coming, the devaluing of their yuan, and they did it on Tuesday. They did it again on Wednesday. They did it again, or I guess Monday night, Tuesday night, and Wednesday night. They did it, creating the havoc to the markets. The last one didn't really stir the pot much. Actually, the market was up most of the day before finishing lower. So today, we finally are seeing some life being breathed into the market as I'm recording this on the 30-minute chart here of the S&P. You can see we've had about an hour and a half worth of buying starting to come in, maybe more like an hour or so. That's welcome, because this market's been about as dull as it can be all day long. And the cool thing about trading is most of the time the bulls have the edge or the bears have the edge. Okay, there's usually a trend line in place. And I'm not talking about the trend from 2009 lows to the end of 2014. I'm talking about short-term trends. There's usually a trend line, because, like, for instance, back in 2011 during that summer, from 2009 to 2014, the market's been trending higher, but there was a huge sell-off in the markets in 2011 that really shook the markets to its core. That was a short-term sell-off, and so there's usually something like that going on, whether it's an uptrend or a downtrend, but it's tradable. But so far this year, there's nothing that's been really tradable except maybe like a week of selling or a week of buying. Outside of that, you can't get anything to be sustained. This is the chart, and I talk about this every time I do one of these Google Hangouts this year. Since mid-February, this market has not done anything. I mean, this is as flat as it can be. If you look at the 9-month chart, I can pull it up here. If you look at not the 9-month, but if you look at the monthly chart of the S&P, you'll see. I mean, this has just been completely flat. I mean, just not going anywhere. And I'm not using this Google Hangout to complain. I'm just telling you, there's markets where the ability to profit mightily is great. 2008 was one of the best trading markets that I had ever been in. It was phenomenal. Now, I know that goes against the grain of what you hear a lot of people say, because most people, 99% of people, only trade to the long side. But trading short, there was no better of a market that I had ever experienced in 2008 for shorting stocks. It was amazing. But here, 2013 had an incredible run to it as well. 2014 was great too. 2015, there just isn't much. So you can't expect that you're going to get like 70, 80% returns in a market where there is no direction. There's no continuity from day to day. I mean, you look at this daily chart just this week alone, and you can see here, okay, we were up big here, down big here, go down real big on Wednesday, and then pop right back up before the close. There's not much to work off of. You can't build a portfolio of good stocks, because basically for 6-7 months here, I've had to be 40% cash for or less for 90% of the time. You do have here, which is pretty interesting, an inverse head and shoulders pattern on the S&P 500. And I want to point that out before I forget. This is on the 30-minute chart, but really well defined. I mean, typically that's not as deep of a head pattern that you'll see, but still, I mean, all the requirements for this to be an inverse head and shoulders pattern is there, and it looks really solid. So if this S&P can break above 2092, 2093, that would be quite nice. I would be very indebted to this market. Right now, I'm sitting at about 50% long. I'm probably going to carry that over the weekend. my portfolio is a snapshot of 4 out of 5 of my positions I have just added literally since the sell-off on Wednesday, and when the market started coming back. I got stopped out of a number of positions, 3 positions to be exact, and then I added back 3 more positions, 2 of which were ones I had just kind of stopped out of, and in order to get back into this market. So that's not typical. You've got to be really flexible. You've got to put your ego aside in this market. If you don't, you're going to find yourself getting into a stock like Twitter, because it looks like it's setting up really nicely here, sort of like what we saw prior to its earnings. And then if you don't read the handwriting on the wall, you're going to get stuck in a kind of a sell-off like what it's seen of late here. So you got to be really careful with your trading in this market. Abide by the stop losses. In a market that's constantly trending higher, the need to abide by your stop losses doesn't feel as important. But we all like to say that we do follow our stop losses in a trending market higher because they don't get hit as often. In a sideways market, they're going to get hit a lot, and you've got to be willing to follow them, and not say, well, I'm just going to stick around a couple more days and see if it comes out, because wrong on every front. When you do that, you're going to get a small loss turning into a big loss. You're going to have a 3 or 4% loss turn into a 20%, 30% loss. That's what happened on Twitter there, and you got to be careful about it, okay? And then there's the other thing where people start looking for stocks like AQXP. If you remember this one from last week, it went just absolutely bonkers off of a couple of news pieces that were very favorable for the company, going from $1.79 all the way up to 55. So then people start saying, well, I'm going to start playing these kind of stocks and hope that I can get one of these drug manufacturers or biotech companies to give me a favorable ruling, and then I'm up 2,000%. Seriously, I do not hardly ever see stocks that do this kind of stuff. And while you're trying to search these kinds of plays out, you're going to probably lose all your money on the stocks that don't do that and do the exact opposite of what you want them to do. So temper your beliefs, okay? Markets work in seasons, okay? There's seasons of a nice uptrend. There's a season of a downtrend. There's seasons where, like right now, where you just have this historical consolidation pattern. And look, I run a membership service, okay? People follow my stocks. And you know what? I could do something, I could just trade just to try and make big gains and everything and hope for the best. But I don't do that because I have a plan in place. I have a discipline in place that has worked for me for years and years and years and years. And I'm going to stick to that plan because it manages the risk. It maximizes the gains. It's not going to guarantee that I'm going to be perfect on every trade. It's not going to guarantee that I'm 80% even on every trade. But what it does do is it allows me to be profitable year in and year out. That doesn't mean that every year I'm going to be unbelievably profitable, because when you get into a consolidated range like what we've had, you can't go, balls to the wall and go 100% long or 100% short at every given opportunity and go 100% long with a 3x ETF and think that that's your key to beating the market, because at the end of the day, you're going to lose. So discipline is so huge in the sideways markets, and not trying to trade according to your fantasies or beliefs or desires. You can't conform the market to your will. That's what I'm trying to say here. You cannot bend the market's will to your own. Instead, you have to follow the market and what it's willing to give you. All right. And a lot of these trades that you're taking, that a lot of traders will make in this kind of a market, is based off of frustration because the market's not doing enough for them. So they think that, okay, if I get into an AQXP or if I get into a Twitter prior to earnings, I can make the money that I want. And guess what? You lose the money that you needed to keep. That's a bad thing for traders, okay? Don't let your emotions get the best of you. There will be seasons for reaping, and there's going to be seasons for planting, but you got to know the difference, man. And right now we're in one of those seasons where we are planting the seeds. If we remain diligent, if we remain disciplined, and we respect the market's will here to just continue to trade sideways until that time that it decides not to, and it decides, hey, we're going to break out or break down, but either way, you're going to finally see that harvest, Okay, but the hard part is trying to remain disciplined during these times. And I wish there was more that I could say about this that would give you a feel good about this market. But right now the S&P, we're stuck in a sideways market. And not only are we stuck in a sideways market, but we're getting into a more and more narrowed range. So going all the way back here, okay, completely sideways. But then if you look at what we've been doing since early July, we've got now a series of higher lows and lower highs in place. That's going to be great if that ultimately sends us into a direction in this market. And if that happens, awesome, okay? But right now, I'd be very weary if the market closes below the 200-day moving average, because that's been a huge support level for the market. And, if it can get back above these highs from 810, I think there's a good chance that we're going to see a test of the all-time highs again. So the 810 highs is 2105. We're about 14 points removed for that, so we're not quite there yet. But if we break that, I think there's a good chance that we're going to see a test back into the 2130s again. So the key to this all, folks, is staying disciplined, man. If you don't do it, there's no reason for you to be trading in this market. You got to keep the head on, and not be saying, oh, I'm not making enough in this market, or I need to be making more because I got to pay this bill and that bill. Figure out a way, man. Figure out a way to stay disciplined, because if you let the pressures of home, if you let the pressures of what you got to be doing or what the market needs to be giving you start affecting your trading, you're better off never trading from the beginning. With that said, we've gone over the market quite a bit here. Let's and basically I don't know where the market's going, guys. I got an edge here. I'm trying to work it here. I'm about 50% long, 50% cash. I'd like to be 70, 80% long, maybe even 90%, but I can't because the market's not giving that to us. But we're holding on to this 200-day moving average. We're right by it. So if it does break below it, there's going to be good reason to get out of some of our positions. But right now, it's giving me a good low risk, high reward opportunity, because if this market does break through and it goes back up to the 2130s, don't know if it will, but if it does, it's a huge profit opportunity, because in the process, the market's going to be moving about 2%, and 2% is like 1,000-year journey for this market these days. So if we get that's stellar. So, but yeah, be willing to react to the market and what it gives you here. Try to take the clues, the subtle nuances of the market, the clues that it gives you, and try to position your portfolio accordingly. A couple of positions to be looking out for here. ITC, I really like that. I don't even think I've ever traded this stock before, but look at this beautiful utility stock. It is breaking out. I think anything over 35 is go time for this stock. It's at 35.07. I'm not going to be adding it because I don't want to add anything else to the portfolio at this time. But overall, this breakout looks very, very promising, and could see a move. It's not going to be a stock that makes you a ton of money on it, but I think it's a pretty steady and dependable one. I think the max ceiling on this is probably around 38 before it starts pulling back again. A couple others, CAR, it's not ready yet either, but you do have a nice inverse head and shoulders pattern here. This being the head, this being the right shoulder, and back over here being the left shoulder here. So really nice pattern there as well. I got into Facebook earlier today, not really doing much. I'm basically break even on it right now. This stock, I've been in and out of this stock like 3 or 4 times in the past month. Anyway, you say, man, just give it up. Give it up, man, because you're not really making anything on this trade so far. I mean, if you go back to a couple months ago, we had a really good run on this stock. We made a lot of money on it. But if you look at the last 3 times, there really hasn't been much opportunity, or I shouldn't say the opportunity's there, but the profits have not been there. So we haven't really made anything off of this trade. But I'm not into trading symbols. I'm into trading charts. So I got out of FB yesterday and I said, you know what, we may be getting back into this again today. And we did. But this candle here prior to today, so I'm going to take off the candle from today. This here looked a bit troublesome. We were still in the bull flag, but it was starting to show signs that maybe it's breaking down. The market really was selling off at the end of the day. So I showed some caution here out of my entire portfolio. Facebook looked like it had some of the most trouble to it. It had been down, let's see, like 4 out of the last 5 days, and just not breaking out of that bull flag that I felt was so promising. Today, it's a different story, though. So it pushes back up, and yeah, it moves 1% before I even get back into it. And you're like, man, why did you even sell it in the first place? And that was because based on the information that I know, it was showing some weakness there. Its behavior yesterday was not typical for what the market was trying to do for most of that day. Most of the day, the FB Facebook was up, and or the market was up and Facebook was down, and then when it sold off, it sold off even more. So that was concerning me. Okay, and we've seen enough volatility this week to where don't question what it's trying to do. Just follow the charts and make decisions accordingly. But now today it's coming back up, so I really like it again. Okay, it looks good, and that's not me being some schizophrenic that that can't make up his mind up about its stock. The chart looks better today, and I like that bull flag again, so I get back into it. There is nothing wrong with that. See, the reason why people don't do that is because their ego. So their ego starts driving their trading decisions. And when their ego starts driving their trading decisions, they can't make good decisions. They can't get back into a stock that they just sold yesterday because they are so determined that stock has to go down after they sell it just to make themselves feel good. I'm not into about making people feel good. I'm not into making myself feel good. I'm into trying to make profits and trying to make them consistently as much as possible. So that's all I'm going to say about Netflix. There are a couple other trades. Keep an eye out on this Goldman Sachs here, man. It is looking rough. I mean, you've got definitely a breakdown of this 203 support level. It's bouncing some today, but I think there's a good chance that especially if this market continues to weaken in the days ahead, that Goldman Sachs is going right back down to 195 or less. Some other long positions, PKG. I've had my eyes on this one today. It's got this 200. Let's see, that's not PKG. Yes. Okay, I was looking at it from the wrong angle here. PKG. I knew something wasn't looking right on it. 200-day moving average. That's been the cause of some resistance for this stock. That's basically the reason why I didn't trade that one instead of Facebook, was because of that 200-day moving average. It may end up breaking through it, but as it stands right now, I want to just back off of it a little bit here and see if it can push through that 200-day. But if it does, I mean, you got a great breakout on your hands. Amazon and Google. Amazon's been pretty flat since its earnings, not really doing too much. But if it gets back above that 540 level, it could find its mojo again and start running back higher. And then you got Google. Google, I'd say, breaks 699, maybe 700, jump back into it. You could say that's like a little bit of a bull flag there, not your typical one, but it's definitely an intriguing play, to say the least, and one worth keeping your eye on. So that's going to do it for today. The weekend is almost upon us, which I couldn't be more thrilled about. If you have any questions, feel free to email me, ryan@shareplanner.com. Or you can join me in the Share Planner Splash Zone that I call home each and every day the market is open. I'm in there from about 9 o'clock till in the morning Eastern time till when the market closes. I'm there every day answering questions, discussing stock trades, giving you my setups. So feel free to check that out. It's a free 7-day trial membership, shareplanner.com/splash zone. And y'all have a great weekend, and God bless.